Good morning, everyone. We will get started in a minute here, just giving folks opportunity to join. And I see them coming in. It's like we still got a few more people coming in right now, so we'll give about another 20 seconds or so. Okay, looks like it's about something. All right, good morning, everyone. Thanks for joining our Income Lab webinar this morning. We're excited to bring another great topic hosted by our two presenters, Justin and Derek. Before I kick it off to them, just going over some quick household items. We will have the first half of the webinar will be the presentation, and then we will open it up for Q&A after. On your Zoom toolbar at the bottom, you'll see the Q&A section there. Please drop all your questions there. After we will kind of run through the queue and get all the questions answered. You can also like and kind of upvote other people's questions if you'd like to move those up in the queue as well. And then outside that, you will see a survey right after the webinar. This is one of our CFP-CE webinars. So afterwards, you'll see the survey where you can fill out your name, CFP ID. So that way we can make sure we get you the CE credit for attending this webinar. Okay. All right, guys. Well, that's my spiel to start this off. Justin, Derek, I will turn it over to you guys, and I'll be back for the Q&A.
All right. Thank you, Malcolm, and thanks everybody for attending. Hope your summer's going well. Today we have, I think, a pretty timely topic, which is how to think about using economic data and economic context when developing retirement income advice. It obviously seems more relevant or important right now, but it's always important. But now, because of higher inflation and some turmoil in equity markets, this is probably something that that a lot of you are thinking about, or a lot of your clients are thinking about. So hopefully this will be timely and helpful. The way that we're going to do the presentation here is first we'll kind of go through 3 examples of types of economic data indicators that can help in providing context for retirement planning. I would think of these as families of indicators, and also that these are not the only ones that might be helpful. So think of these again as examples, not as the only things to look at, or exactly the mathematical key to determining retirement advice. So we'll look at price earnings indicators, something I'm calling nest egg, you'll see what that is, and inflation, which is probably on a lot of people's minds. Then we'll talk about what types of plans are most helped by applying economic context. And then probably most importantly is the third thing, which is how we might include economic context in client communication about retirement planning. And then finally, we'll dive into some of the analytics surrounding how you might tilt retirement income advice based on economic context. And on that last part, I think whenever we talk about applying economic context, market context to advice, it's reasonable to get a little bit worried that, is this market timing? Is this the kind of thing where there's really, evidence to show that these are strong? I think you'll see throughout that the data shows that the longer, both the longer the plan that we're applying this to, and the longer the economic measure is in terms of, how quickly it moves. So we want it to move rather slowly. The better these indicators are for helping provide better retirement planning advice. So this isn't really the equivalent of day trading or stock picking. It's much more about kind of long-term strategic positioning in retirement income planning. So let's start out with our 3 examples. So the first is probably the most well-known. So, and a lot of people have written about this. I know Michael Kitsis and people on the Kitsis blog. I've seen other things in journals about price earnings ratios and how those can help people in their retirement income planning. So, just a quick recap. Price earnings, typically when you hear that on, on TV or something, they're talking about current price divided by most recent earnings or maybe projected next quarter earnings. But what we're going to be looking at is, I think we could just put under the rubric of CAPE, which is cyclically adjusted price to earnings ratio, or really just price over a long-term earnings pattern. So average earnings over a long time window. So does this help? Is there a connection to retirement income? And if so, what is it? So you'll see this this pattern throughout these 3 examples, but with price earnings ratio, we see that the longer the time window over which we measure those earnings, basically the more explanatory power, which is a term, of the art in statistics. It's a way to avoid saying, predictive power. It's correlation, not necessarily causation. The higher the explanatory power of price earnings ratio, or CAPE, is, up to a point, right? So you can see here, as we go from 0 years, so maybe it's 1 quarter or 2 quarters, we have relatively low R squared, relatively low explanatory power, although, honestly, 0.29 isn't the end of the world. But getting up to close to 0.7, which is quite a robust R squared as we get toward 20 years. So again, this is a pattern we'll see with every example here. If we use kind of a longer term indicator, we get better information about retirement income. And what I'm doing here is comparing it. So comparing the CAPE value, basically, to the amount that someone could have withdrawn from a portfolio, in this case, a 60-40 portfolio, over 30 years. So it's really the connection between CAPE and systematic withdrawals. Now, those of you who've been on these webinars before or who use Income Lab know, that is not the only thing important to retirement income. People will have other income sources and so on, but we've simplified here to imagine people are just funding their retirement from systematic withdrawals. Okay, so this relationship, as you might expect, is inverse. So if you have high PE, high CAPE, that means that stocks are relatively expensive, at least earnings are relatively expensive. And so the more expensive those are, historically, which is the only way that we can measure this kind of thing, right? We have to look at the actual historical patterns. The higher CAPE is, the lower the systematic withdrawal rate that was available going forward. So you see that on the left with the box plot, which is, sloping down and to the right. So when CAPE is particularly low, the sustainable withdrawal rates were typically quite high. So to remind you, what a box plot shows is that center box is the middle 50%. And then the whiskers are the edge 25%. So you can see it's a relatively wide dispersion, but the bulk of it is definitely quite high. 20-year CAPE, looks very similar to 10-year CAPE. So that's the one you typically see talked about. And you can see that since about the late 90s, CAPE has been elevated quite a bit compared to history. The one exception was the 2008 period. There is a lot of talk about this pattern. And I think there are some plausible reasons to think that it's a little bit of a data problem because earnings measures have changed. And so it's possible that CAPE is not quite as elevated compared to history as it looks here. But just taking it on face value, this clearly indicates that, elevated CAPE with respect to history would typically mean that advisors would be a little bit more conservative on their withdrawal advice for clients, right? However, CAPE, because we're talking about stock earnings, is not as useful if the allocation is not as heavy in stock. So you see here, if stock allocations are down in the 10, 20% range, the explanatory power is much lower than if we get up to higher stock allocation levels. Again, should not be surprising to any of us, of course, right? This is a stock indicator, so presumably it's going to be more useful when applied to plans where stock performance matters for retirement income planning. We'll see as we go on some more examples of this, but in practice, what we do at Income Lab is we actually combine indicators together so that we're always presenting kind of a broader picture of economic context rather than highlighting a single indicator. Okay, our second example is what we call nest eggs. And really, this is just a way of measuring previous sequence of returns, okay? But it's always more helpful to kind of tell a story about things. It's more memorable. So think about it this way. This is the amount of money that would be available after some length of time of systematic savings, right? So imagine, for example, you were saving $1,000 a month, adjusted for inflation, for 35 years, and then you were going to use that as a source for withdrawals to fund your lifestyle in retirement. That measure would have been very different at different times in history. So on the right here, you'll see the blue line shows how much someone would have had if they had engaged in that kind of savings behavior, systematic savings behavior. Huge differences in the portfolio someone would have had at different times in retirement. And you can also see this compared to the sustainable withdrawal rate. This is a 30-year sustainable withdrawal rate. All of this is for 60/40 portfolios. But you can see this incredible kind of butterfly pattern, this inverse pattern. So again, a very strong inverse relationship between previous sequence of returns and future sequence of returns. That's what this is showing. As with CAPE, the longer window we use to measure the nest egg, the better. So the more explanatory power this measure has in helping provide some context around withdrawals. So you can see if we're looking at 0 to let's say 15 years of systematic savings, that's not enough previous sequence of returns to really provide a lot of explanatory power. But once we get up to 20, 25, 30, 35 years, we're looking at, again, quite strong explanatory power for withdrawals. Here, unlike CAPE, which appears to be quite elevated, a little less so now, but still compared to history, quite elevated. For nest eggs, we see a little bit more of a kind of a middle of the road pattern. So, back in 2000, the nest egg value for 35 years of savings was quite high, more than almost, I think it was 2.5 standard deviations past the mean. So way out on the high end. More recently, it's still above average. Actually, that may have changed in the last month or so. These data were from a little while ago, but we're more kind of closer to the average. So if you take these two things, CAPE and nest egg, or previous sequence of returns, together, it's maybe not as, nest egg is not painting as dire a picture for retirees as CAPE is. The other nice thing about nest egg or previous sequence of returns is that the explanatory power is relatively high no matter the allocation. And the highest levels are found with kind of balanced portfolio allocations. So here we're matching prior sequence of returns for some allocation, call it 60/40 or 20/80 or 80/20, to following sequence of returns for the same portfolio. So always matching things together. This is why, although the story about saving and spending is nice, that's not actually what we mean with nest egg. What we mean is match the same portfolio, look at sequence of returns before and after. In practice, someone might invest differently in their saving period and in their retirement period, or differently in different parts of those times. But here we're matching them together. And we can see that, again, nest egg is probably a little bit more useful across a wider range of portfolios used to fund retirement, because even if there's a lot of bonds, or we have relatively high explanatory power. So again, a useful indicator for providing some context. Okay, the last of our three examples is around inflation. So this is probably the hottest topic right now. And unfortunately, short-term inflation, so just this year, the change in CPI over the last 12 months does almost nothing to help us understand what someone might be able to withdraw from their portfolio over the next 30 years. So you can see on the left that explanatory power is very low if we're just looking at the last 0 years, 1 year. It's 0.05. It's basically zero. However, if we look at longer windows of average inflation, so what's the trend in inflation? We do actually get, once you get above 8, 10, 15, even 20 years, we get some reasonable connections between that longer term pattern of inflation with what sorts of withdrawals might be possible going forward. And the connection here is a positive correlation. So it's not inverse like the other two were. Basically, historically, when inflation has been very high for longer periods of time, people have typically been able to withdraw more from their portfolio going forward. When inflation has been very low for long periods of time, people have been able to withdraw less from their portfolio. That can be a little counterintuitive, right? We think of high inflation as being a time of a lot of turmoil, and it typically is. However, what we're seeing here is basically a reversion to the mean pattern, or the idea that, yes, inflation might have been very high in, let's say, the 70s, but it came down in the 80s and was accompanied by really strong, equity markets and bond markets. And so really what we see with inflation is, and vice versa, extremely low inflation may think, well, that's great stability. That's probably a good situation. And again, it is. At the time, it feels that way. But over very long periods, what we see is kind of this reversion to the mean, this alternation. So for example, in the mid 60s, which is really the poster child for a period where relatively low withdrawals were possible. It's where the 4% rule comes from. That is the period that in the last 100 years that had the lowest withdrawal rates possible. Actually, in the mid 60s, inflation wasn't all that bad. It's that higher inflation was coming, poor returns were coming, right? So it was about what was coming in the future. So long-term inflation at that point was trending quite low. It was actually not too unlike what we experienced recently through the teens, where it was 2.5. I mean, we saw deflation in the United States a couple times in the last 10 years. The difference so far is that the returns somebody might have seen from 1965 through, let's say, the early 70s were much worse than what somebody would have seen so far if they had retired, let's say, 5 years ago, because they had seen robust returns since then. So time will tell how much these periods, the 60s and the 2020s, rhyme, but that's really what we're seeing here. So the example you see on the screen shows these periods in, for example, the late 40s with where inflation was relatively high, going down to the mid 60s where inflation was relatively low, and you see a drop from 5% to 4% sustainable withdrawals. That's not as incredible as going to the early 80s where inflation was incredibly high, and we know now that withdrawal rates were relatively high. Keep in mind that the nest eggs available at these points would have been quite different, right? So the nest egg in the early 80s would not have been as high, but with a higher withdrawal rate, the dollar amounts withdrawn would have been better than expected. Okay, and just like the other two indicators, CAPE, which was strongest with high stock allocations, nest eggs, which had reasonable levels of explanatory power across portfolio types. Inflation measures are shown here compared to the allocation, and we see kind of the reverse of what we saw with CAPE. So here, inflation matters more for bond-heavy allocations. That makes sense because inflation is much more connected with bond performance. I would also say inflation is very important for people who have income streams that are not tied to inflation. So, let's say Social Security is tied to inflation, but many people would have a nominal, meaning not adjusted for inflation, pension from work. And so for a plan that relies heavily on such a pension, we would also see extremely high explanatory power. So this is, we're mostly focusing on connections to portfolios and withdrawals from those portfolios, but some of these indicators, in particular inflation, can be really important for plans that are a little bit more, diverse in their sources of income. Okay, so what we've seen so far is that generally a longer term economic indicator will provide more context, more information to an advisor who's trying to figure out, what might my client be in for as they're going through the rest of their retirement or embarking on retirement for the first time. We can also see that connecting those longer term indicators to longer term plans provides more help in the planning process. So if we're dealing with shorter plans, the explanatory power is lower. So, what we see here is down to a 5-year plan. That's probably fairly rare, but if people are a little further on in life, 5 or 10-year plans might be around. And we see that in particular, CAPE and nest egg are much lower. This is basically just showing again that short-term, using short-term, using any context to provide short-term kind of tactical approaches is not as robust as kind of the longer-term strategic positioning. Okay, so the takeaways from these examples, and again, these are just examples. We've looked at lots of other things, but these are quite strong. Is that longer-term versions of economic measures tend to have more power than shorter-term measures. More explanatory power is found when matching economic factors to the factors that most affect the plan that you're working on. And longer-term plans have the most to gain from economic context. Okay, so now we'll turn to using economic context in client communication. And I think this may be the most important part of the presentation. So economic context can be used in a bunch of ways in planning. You can certainly use it to tilt income advice up or down when income risk is estimated to be particularly high or particularly low. And we'll talk a little bit about that at the end of the presentation. But you can also simply use it to enrich client communication, to kind of help clients understand the connections between economics and retirement income that might be particularly helpful when a client has a particular worry. Maybe it's inflation, maybe it's recession or depression. So that's where economic context can really help. And we found that providing a historical picture of the context really can help clients understand what the retirement plan you're presenting to them really means, and how it compares to the other sorts of things that might have happened in the past or could happen in the future. So it's a little bit more concrete than just using kind of abstract statistical measures. For example, I would certainly not present clients R-squared numbers when talking about economic context. So in the Income Lab platform, you've seen we have a historical analysis graph. It looks like this. different colors here, but and what this shows is for the given retirement plan, so the given mix of income sources, the portfolio, and so on, what income level would have been available to somebody with that plan if they were to have experienced the sequence of returns and inflation sequences from the past. So we know these were real sequences of returns and inflation that people really experienced. So we know that at least that is the range of what's possible. And so that graph shows you the range. And you'll see here, this is a plan that depends only on portfolio withdrawals, which again, that's not all that common, but it's helpful to just kind of simplify things. And we see here that there's quite a range, right? Again, we saw from the early 80s, very high withdrawal rates were possible. From the mid 60s, they were much lower. See a similar thing, although most of us wouldn't remember this, from the Roaring 20s versus the period right around the crash of 1929. So this huge range, right? Highs and lows. But helping clients understand, okay, yes, this is the historical picture, but which of these pictures should we bother looking at, right? I mean, just although inflation is getting much higher now, and so we're getting more similar to the 1980s, in general, we're still more like the 60s and 70s than those periods. Keep in mind, interest rates were in the teens, right? And so we can say, look, we've looked at, your plan depends heavily on the performance of your investments, right? So we're really looking at, are stocks highly valued or not? And if we look at history, we see that in general, in time periods like today, when stocks were valued, more like they are today, people could have afforded a lower withdrawal. So they spent if they had spent less from their portfolio, they would have had a better time of it, right? Had fewer downward adjustments. That's what this is really showing, the red versus the blue. Let's take an example of a nominal pension. So let's say somebody, again, we'll completely simplify and say the only thing they have is a $60,000 a year nominal pension. So here, not really taking portfolio withdrawals into account, how much of that nominal pension could they have spent saving the rest into a portfolio? So there's some performance of investments involved here. And again, survived 30 years, not had to reduce their income. Very different picture here, although we do see that peak again in the 1920s. That's actually because there was a lot of deflation coming up. But you can again say, okay, there's quite a range of what someone could have spent from this $60,000 a year nominal pension, all the way from basically spending all 60,000 of it every year and don't worry about it from the 1920s to periods where they were spending basically half and saving the rest to accommodate future cost of living adjustments, right? So kind of putting some money away to account for those. And so in the conversation with a client like this, we could say, well, let's look at the periods where the longer term inflation trends were more similar to today. So again, that picks out the 60s and early 70s here. It does not pick out the 80s and 90s. And we can say, okay, we have a choice here. We could assume that inflation will be the worst it's ever been and spend half of this, or we could, maybe we'll spend a little bit more than that, thinking that, well, maybe we won't have, 10, 15 years of horrible inflation. But if we do, we'll be ready to adjust, right? This gives you a way to have that conversation. In this example, which is admittedly pretty extreme, helping someone understand that they couldn't spend their entire $60,000 a year pension would be potentially quite difficult. So this could help a bit. And as I said, on Income Lab, we actually combine economic indicators to just provide a kind of a broader picture, because plans tend to be complex. They tend to have lots of moving parts, lots of inputs, and you're able to dive in a little bit more. So you can even, we had an advisor tell us that a client was particularly worried about kind of Great Depression type experiences. Well, you can zoom in and say, okay, here's the crash of 1929, here's World War I, here's World War II, and we can look at, the income proposal versus what we know someone could have afforded with the same sequence of returns and sequence of inflation that someone would have experienced during the Great Depression. So this gives kind of concrete connections in the minds of these people. Now, most of us didn't live through the Great Depression, but we can at least see what it might have looked like. And again, here, the blue in Income Lab picks out the periods that are closest to today in economic terms. It does not mean that they're exactly the same as today. It's just the gray stuff is the things farthest away. We kind of light gray those and kind of background those and foreground the blue to pick out periods that are maybe most comparable to today. Okay, so that's a little bit about communication and communicating economic context. I wrote an article on the Kitsis blog where I kind of some example kind of scripts about these things too. So you might have a look at that. We'll close with a little bit on tilting retirement income advice using economic context. So a little bit more on the analytical side. If you've had enough charts for today, just close your eyes and this part will fly by. So to show how kind of the risk picture changes, or how you can view retirement risk using a lens of economic context, we use this tool that Derek and I developed. We have some articles in Kitsis as well that we call the spending risk curve. And this is just a way to show that there's a trade-off in retirement. You can have higher income and higher spending, as long as you're willing to accept a higher risk that spending is too high and you'll have to reduce it at some point. Or if you prefer to really minimize the chances that you'll have to lower your income, you're going to have to accept lower income and lower spending right now. It's just a trade-off. There's no right answer. People will find themselves anywhere along this. And we display this as a curve. So just saying risk level 0 to 100, which is equivalent to kind of in a different framing, a probability of success of 100 to 0, or probability of failure of 0 to 100. And it just shows the trade-off here, right? So we see if we could accept going from a risk of 10 to a risk of 20, in this case, somebody could have gone from 45,600 to 51,900 in annual withdrawals. So this kind of shows the trade-off between risk level, probability of failure and success, and income level. So with that in mind, we can use our historical data and say, well, what does risk look like when you apply a lens, in this case of CAPE? So in 2022, these numbers are from March. If we took all of available history and did the same thing, ranked how much could somebody have afforded to spend from $1 million portfolio at every risk level, right? We can see way over on the 100 side, there was one time in history where someone could have spent, almost 12% of that portfolio, right? Whereas on the far left side, we see, a little bit below $40,000, a little bit below 4%. That's from the early part of the 20th century. So that's the blue line is everything in history. But what if we only look at times where CAPE was particularly elevated? So we exclude all of those really low CAPE periods, right? Let's exclude the early 80s and so on. Well, if we do that, the available income at every risk level goes down, right? So this shows the risk level 30, we go from 52.2 to 46.9, right? At every single risk level, we're going down. So this again shows that if you want to tilt your advice, in this case for someone who has a stock heavy plan, it might be prudent if you take the CAPE pattern seriously to kind of dial that down. Now, this is not always what you would see. So in 1982, and using only data available from 1982, so no foresight here, the opposite happens. So if we excluded periods that are least like 1982, so basically excluding all the high CAPE periods because CAPE was quite low in 1982. The blue line shows everything from history up to 1982. The red line is through that CAPE lens, right? So at this point, income available at every risk level has gone up. So at 30, we went from 53.2 to 65.5. So someone in 1982 who was taking CAPE seriously, which would have been a trick since the concept of CAPE did not yet exist, but the data was available, they would have felt comfortable tilting their income advice up at that point. And in retrospect, of course, that is actually true. The early 80s somebody could have afforded a higher withdrawal rate without taking on more risk. So that's what this is showing you, just this concept of tilting advice up or down. But of course, for client communication, talking about proposed income and retirement, except in extremely limited circumstances, the point is that this will simply affect the proposal. So if you are applying a tilt, if you're applying economic context, then the proposed income, all else being equal right now, would be a little bit lower. In 1982, it would have been a little bit higher. So that is sort of the so what of this, is how it affects people's lives. And then as time goes on, if you're tracking a plan and income lab and we reached a point where that was more like 1982, the reverse would actually be true. So if you're applying a tilt, you would actually get a little higher income than you would if you were not applying that tilt. So I know that was a lot of data, a lot of charts, but hopefully we have some good questions and so on. But first, as usual, we'll turn it over to Derek. And I'm curious, Derek, what kinds of thoughts you have on applying economic context and also just conversations you're having with clients right now.
Yeah, and I think for me, really the power, again, of having these analytics, of knowing that I can tilt kind of my advice in that direction is really useful. It's not something that I get, really into the weeds of, what economic context is, how we select it. But one chart I really, I really like the chart on the historical analysis tab, when I can go there and show somebody, here's what it looked like. Here's the planned level of spending. And this, this graphic right here is a good example of it, where I can really point out for at least, almost all periods in history, right, we're seeing that the spending level here is lower than what we'd be looking at. And I think that's provides a lot of peace of mind. It's one of those slides that when I go to this, somebody realizes, okay, yeah, if they could have lived through world wars and everything that's happened from there. And I do like to pull out some of those historical events, which you can do by just toggling on the little purple triangle there and highlight what that is. I think that has been really effective in terms of kind of helping somebody understand the level of conservativeness that's going into a plan. And really, for me, that's been one of the kind of the way I actually use economic context for my clients, is to quick kind of go over that chart, show the relative conservativeness of the plan relative to history. And then, I can make a quick note as well about the blue shaded areas and how those better reflect the economic conditions we're in now, and why those periods, we kind of give those a little bit more weight when we're thinking about how much they can spend. But for me, that's about the level of depth I'm actually getting into, the communication with the clients, even though obviously I love all the stats and power and everything else behind it from an analytical perspective, but I like to keep things pretty simple. And I think in general, that conversation's gone well with clients, and even, talking through things like the inflation in the 70s and 80s, when people, where we're at now, that's obviously coming up more and more. And, letting them understand it was a combination of the low returns coming for people in the 60s, plus that high inflation. That they're certainly taking that into account when we're finding their overall spending level, I think is useful. So yeah, happy to jump into questions, but I think that's, if somebody's looking for the really practical kind of, where do I see a lot of conversations coming up, it's often this chart here, not diving too deep into the technical weeds unless the client really wants to.
I was just wondering, when you have those historical conversations, do you ever have somebody say, yeah, but what if it's worse in the future than anything we've ever seen in the past? Or do you not have as pessimistic of a clientele?
It hasn't come up much. I sometimes I like to pull up kind of the world wars and some of that right away as I'm showing the chart, and some, like if I'm presenting actually outside of Income Lab, maybe in a PowerPoint or something, I'll have those on there. And I don't know if that maybe deters some of that when people think, okay, yeah, these include world wars, these include, you know, some tough time periods. But I'm sure that question could come up. And I think, you know, my answer there would be that, you know, that's why we're going to take a dynamic approach, and we'll make adjustments when adjustments are called for, because it certainly could be the case that past could be worse than in history. But also pointing back to, you know, let's look at some of the events that are on the timeline here. This is not all, you know, rosy great periods, and we still see the, you know, often it's not always the case, and sometimes there's a few periods that were are showing up below the planned income level, but oftentimes it's just a few, and that's where I'm having more of that conversation about adjustment.
Yeah, the inflation in the 70s and 80s was profound and long term. So yeah, I think that's important to remind people. Like, we actually have seen some relatively bad inflation in the United States before. And yeah, as you said, it can depend quite a bit on the actual plan, right? So we do sometimes see kind of the teens, the 19 teens are sort of the worst period. But typically those are, you know, those have to be plans that have a decent dependence on withdrawals. So the more you might have Social Security and things like that, you might see those come up. But that's helpful. Thank you. Oakley, do we have some questions?
We do. Thanks, guys. And to our attendees, please drop your questions into the Q&A. I will start with the first few ones that we have here. First question is, just really user want to kind of review the nest egg slide again. They said they didn't really understand that slide, so I'm really wondering if you could touch that.
It's probably that concept of nest egg is potentially the least, maybe least familiar to people. Yep. So again, really what this is measuring is sequence of returns prior to some point in time, and its relationship to sequence of returns after that point in time. So it's really just it's a way of kind of showing reversion to the mean, or sort of this cyclical nature of investment performance historically. So the blue line here shows if someone had spent 35 years saving systematically $1,000 a month adjusted for inflation, which I get is probably not what most people do, right? But again, this is just a way to measure previous sequence of returns. So for example, the first one here is 1906. That's the retirement date. So for the 35 years before that, that person had been saving $1,000 a month. And they had, you know, quite a bit, above 1.6 million in inflation adjusted dollars, right? Whereas somebody who was retiring in the, you know, roughly 1920, they would have had only $400,000. So hugely different sequence of return there. And actually what we see with sequence of return previous to today, or affecting this nest egg amount, is that it's the most recent returns that matter the most for our portfolio, because in this case we've been saving systematically. So starting out, we don't have much money, right? We put our first 1,000 in, and then our next 1,000, and so on. But at the end, we have a lot of funds we've put in there, and so the same return percentage will have a larger dollar effect on this. So it's basically sequence of return. We all know that in retirement, what matters most is sequence of return soon after retirement. The same is true looking backward. So the most recent sequence of return matters the most. So that's what this is showing. And then the red is simply showing, okay, from that point forward, right? So call it 1920. What could someone have actually afforded in withdrawals with full knowledge of the future, right? So this is looking at actual history. And we know that actually that person in 1920 could have afforded very large percentage withdrawals, which would have helped their situation a lot. That's because the 1920s had very good returns until we got to 1929. So that's what that's showing. I think that was maybe the slide that.
Yep. And then actually we had a kind of a follow-up on that one. So I don't know, maybe you want to go back to that last slide, but kind of the follow-up question is from a different attendee is, you know, they're having trouble making the connection with nest egg and sequence of returns. So are you saying high nest egg implies good prior sequence of returns? So more likely that sequence of returns is bad going forward, so lower withdrawal rate?
Exactly. And it's perfectly fine to think of this just as nest egg. Think of it as your dollar amount. I keep connecting it to sequence of returns because that is what it's based on. But if you just think, okay, do people have, all else being equal, if they had stayed invested, would they have large nest eggs now, or would they be low compared to history? And that they're high if things have been good recently, and they're low if things have been bad recently. And what this is showing is that cyclical nature of, okay, if things are going really well, people have larger nest eggs, but with that comes the idea that maybe they shouldn't spend as much of that nest egg as a percentage as they might have in a different situation. So a lot of people have been talking about this recently. I know Morningstar had some research that came out recently, and they tried to, there were headlines about this being, oh, the 4% rule is now 3.3, but there was a lot of work in there was saying, hey, by the way, there's a connection here to, they didn't call it nest eggs, but essentially how much money you have. And that goes a long way to helping people actually still have an okay standard of living, even if the withdrawal rate is relatively low compared to history, the dollar amounts might be still pretty reasonable.
Gotcha. Awesome. And then next question here is more feedback, actually. Feedback here says, it'd be helpful if we could add an appendix to Income Lab reports, which contain key economic dates, I'm assuming data such as CAPE, projected inflation, etc. The user said this could inform the client discussion and reduce the black box aspect of the withdrawal recommendation.
Yeah, that might be possible for sure.
Yeah, definitely. And I know, in our reports, we have our assumptions reports in the glossary as well, which kind of helps already kind of give some of that information up front. So I could maybe just see us expanding on that already.
One additional on the kind of the black box element, everybody might be different levels of familiarity with what we're doing in the software. But if you go to, I think Justin and I have a Kitsis article on the retirement distribution hatchet. And I think that's a good one for really trying to get perhaps more foundational, just kind of what's going on and setting those recommendations and how thinking of kind of total risk guardrails, how those differ from withdrawal rate driven guardrails. I think part of our intent in writing that was to help put some terminology and understanding around this framework and what it's actually doing. So I found that's one that sometimes if somebody is feeling, where does this come from? That's another good resource to go to. Not so much on economic context, that's different, but might find that useful.
Nice. Thanks, Derek. Do we have any other questions? Those are the Q&A that's coming in so far. For our users still here, please drop in more questions. Derek, while we're waiting on those, one question I know you briefly talked about how you explain the historical analysis chart. And I know, working with users, one question they ask is, what are the kind of questions clients most often ask when you do show them that page?
For me, and apologize, I was reading one of the questions there too at the same time, but so you're talking about the historical analysis chart, that one specifically? Mm-hmm, mm-hmm. Yeah. So I really do think it's an interesting, some clients, it's a very quick, they just kind of gloss over it and it's like, oh, that was, that's nice to know this is relatively conservative from a historical perspective. Some of the clients, it's, whatever it is about, they enjoy history, they enjoy, like I've had clients that just really get lost in this chart almost of, oh, can we, what was this, what was that, what was the, especially when you look at like the recessions and some of all the neat things you can turn on in the chart that just really get into it from a historical perspective. So I do have a lot of questions that come up, I think, around that and why were certain areas low? Like, why do we see the mid 60s having a dip there? Why do we see the teens with the dip? So I think as an advisor, being prepared to answer some of those questions can definitely be useful. So kind of having an understanding of what's going on, what's driving that, so that you don't just get that kind of question out of the blue and not sure how to answer that. But again, for me, it's just a lot of getting into the tool, understanding it, looking at the history that was there, seeing what was going on. And sometimes it's okay to walk away and say that's something I need to look into, because I'm not a economic historian by any means. And so sometimes somebody will hit me with a question I don't quite know.
Gotcha. Cool. We got some more coming in. This one I can answer. The question is, where can we find a list of these great articles referenced? You can find them on our website in our resource section. We have all the articles, links to all the ones that Justin and Derek have done specifically on KITSA, so you can access them through our website, as well as other articles that we've published, all on our resource page. And then you can also view all of the previous webinar recordings as well. And then next question here is, sequence of returns is a look back in history. How does that apply today to deciding how much to withdraw in 2002 and 2003?
Yeah, that's a great question. So in order to study the link between economic context and sequence of returns, we have to use history, right? I mean, there's no way to, or it wouldn't be very interesting to randomize economic context in a Monte Carlo context. So that's everything that you've seen in the presentation is doing that. That being said, I know that there is value, and a lot of people are using, particularly today, they might say, hey, look, if I use historical sequences of return, historical sequences of inflation, which I think that's maybe a more important term than we've understood in the past, sequence of inflation, right? High then low, that kind of thing. If you're using historical patterns, you're saying, okay, it could be a broad range of things, but you might have a very strong opinion that inflation will be higher for a period, and it's not really even an uncertainty, right? And so then I've seen people go to our regime-based Monte Carlo analysis method, where then you can kind of put your thumb on the scale, change your inflation assumptions, at least for the near term, say, hey, we know inflation is higher, and let's look at what that might mean for your plan, if it lasts for 5-10 years. And then you can see how that affects the proposed income. So that is a way I know, using history. Again, I think I started this presentation by saying it can make us feel a little uncomfortable, right? Because we're saying, maybe this is the only set of things that could happen. That's a good way to kind of apply that opinion, if that is your opinion of, and it doesn't have to be that you're predicting that that's exactly what's going to happen. You might just want to understand, how would I adjust my income advice for somebody if I want to make sure that they're protected from kind of a medium-term high inflation period?
Perfect. And next question is, when you're talking about tilting advice for economic context, would we start with the income lab proposed income and then further adjust that amount for current CAPE inflation, et cetera? Or does an income lab already build these factors into the proposed income figures? Any suggestions or clarifications?
Yeah, if you're using the historical analysis method, which uses historical sequence of returns and sequence of inflation, then you're already applying economic context. If you want to adjust that, it's actually right here, this slider. So you can turn it off completely, right? You could say, I think this stuff is nonsense. Don't do it. And then apply it to the plan. The other way to do it would be, as I said, maybe you have particular, things you want to do, like adjust for higher inflation. So then you would want to go to the capital market assumptions and adjust, for example, your inflation for typically what people would do is use the regime based, because then you're not saying, well, it's going to be like this forever, 30, 40 years. You'd be saying, okay, well, I have a nearer term view, maybe it's 10 years, maybe it's less. And you could adjust, your inflation and your inflation standard deviation. So again, an income lab, we don't assume inflation is just flat and stays the same every month, every year of the plan. It's varying it the same way that it varies investment returns.
And then two more questions. I know we've got about 5 minutes here, so just want to be mindful of everyone's time. So second last question is following up on the next egg. So in 1920, is the graph indicating that they were able to withdraw over 10% from the lower 400K beginning nest egg? then I can let you get to that.
I think that's right. If I don't have a photographic, but yeah, that's exactly right. So now these are very brief peaks, right? So you're catching a falling knife there, but yeah, exactly, kind of that 1920. That could have been, I'm not sure exactly what year it is, but the sustainable withdrawal rate was above 10%, but from a $400,000 portfolio. So we've actually done we had a webinar, I think it was on something like what's the worst time to retire in history, where we kind of we talk about this concept. I don't know that we called it nest egg, we might have, but this idea that it's the combination of how much money you have and how much you withdraw as a percentage that leads to your standard of living. And that's exactly what you would see here, is that the blue line times the red line is a much more, it's a much smoother line. It's not completely flat, but it's a much smoother line.
And then a question here is, if a client utilizes a cash bucketing approach, how does that factor into the income lab analysis?
So I would depend on what you mean by cash bucketing. I definitely, I would make sure you have the cash allocation put in there, and then it will apply either your capital market assumptions regarding the performance of cash, or the historical patterns of cash returns. And that is a very important input to the proposed income. I know, Derek, you've talked before, and we don't have a feature for this on Income Lab, but ways of kind of talking about maybe some of the safer assets, although in inflation periods, I hesitate to call cash safe, but and how you talk about that with clients.
Yeah, so I mean, I personally like to use, Michael Kitces has an article on using bucketing strategies as more of a psychological tool than an actual kind of portfolio management tool. That's largely how I personally use buckets in my practice. So I talk about buckets. I talk about having a protection bucket, a growth bucket. I like a very simplified two kind of bucket framework. But for me, it's understanding Income Lab's just going to be looking at the allocation that you have set in there. So getting that cash setting correct, as Justin mentioned. But if you're actually wanting to analyze like spending down one of those buckets, that's not something that, just to be clear, that's as far as I'm aware, that's not something that can be done in the software.
No, that's right.
And then these last two are more just kind of suggestions for future topics. And so to close out, I would kind of walk through those. So first one is, it'd be nice for future webinars to show how to apply different analysis methods. So the historical versus Monte Carlo versus regime-based. Yeah, great topic. I think we could do that in the future. And then last one is, looks like, so we have a user, starting to get notices that plans are needing adjustments and some are in positive directions. Any chance we could have a webinar to review how to understand implemented plan adjustments in the near future?
That's a great idea as well.
Yeah.
Yep, I think we can definitely do that. We could, we'll create some fake plans that had different types of adjustments, and we'll look at them and see why and so on. Yep, that's good.
Perfect. Awesome. Well, hey, I love it. Justin, Derek, again, thank you guys so much. We really appreciate the time you make to keep bringing these amazing webinars for us and our users. For anyone else who's signed up, we will again send out the recording later for your review. As soon as I close off the webinar, you will get that survey to put in your CFP information. And oh, sorry, we had one last. No, Ryan, you don't have to subscribe to Bridgetti to get that integration up. I will actually send you an email here with some information to help you get that integration set up. Outside of that, guys, thank you so much. And we will see everyone on the next one. Take care.
Thanks, everybody.